This is Bloomberg Intelligence.
Usually when the consumer's under pressure, dollar stores do really well.
We still see R&D spending for the big biopharma companies holding steady.
In-depth research and data on 2,000 companies and 130 industries.
The one area that Netflix hasn't yet ventured into is sports.
As dominant as PepsiCo is, it can even do better.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
I'm Paul Sweeney. Alix Steele is out today. On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we examine how streaming companies will survive as consumers curb spending and look at the M&A landscape in 2024. But first, mutual funds aren't dead yet. For more, I'm joined by Bloomberg Intelligence mutual fund analyst David Cohne. David, if they're not dead yet, it seems like they're dying a slow death as more and more funds go to ETFs. Set that up for us.
Well, you're right. They are kind of moving in that direction as more assets flow to ETFs. The mutual fund industry is definitely in trouble, but it's not going anywhere. There's trillions of money in target date funds and retirement accounts, and you think of 401ks. That money's not going anywhere. ETFs lose their primary tax benefit in a 401k, so mutual funds will continue to have a place in 401ks for the time being. I don't see that changing for the foreseeable future. So while they may be slowly dying, they're not going anywhere.
So explain to us how the mutual fund industry responds to what's been happening over the last 10 plus years in terms of the flows to ETFs. What has been the response of the mutual fund industry?
Well, I think they're finally starting to understand that they're going to have to lower their expenses, their expense ratios. You're starting to see it happen a little bit, but I think they haven't really moved or really understand that they're not going to be able to compete. And I think some of these leaders of the companies are really going to have to start really thinking about, making sacrifices for today, which means, if you cut the expense ratio, that cuts their revenue, but it does set them up for the long term to be able to survive. And so I think, they haven't really made the necessary changes. They're starting to do it a little bit, but they're really going to have to lower expense ratios to be able to compete.
So give us just a sense of kind of where, the mutual fund assets under management have gone.
Everyone, over the last year, 2023 was the year of the money market. There are, through December, there's about $4.9 trillion in money market assets. And so really a lot of flows last year went into money markets. Now, money is also flowing into fixed income funds. So if you think of fixed income, it's easy to outperform in a fixed income fund. You have way more securities to cover, which provides more alpha opportunities. A lot of these funds benchmark against the Bloomberg aggregate. And if you think of that index, the aggregate doesn't include higher yielding bonds or small issuers. And so bond managers can invest in those securities, which can make it easier for them to outperform. And so I think there's an opportunity in fixed income funds, especially aggregate bond funds, for managers to continue to outperform, which can help their flows as well.
So it's interesting here, like on the ETF front, it started out as a passive product. Therefore, it could, in fact, charge these really low fees relative to mutual funds, which are actively managed. But now we're seeing actively managed ETFs. How does the expense comparison compare? How does it shape up for an actively managed ETF versus, say, the run-of-the-mill mutual fund?
Well, the active ETFs do have, on aggregate, lower expense ratios, even in, actively managed products. One of the things we found, both me on the mutual fund side and my ETF colleagues, is that 40 basis points seems to be a magic number. It's an expense ratio. If you have your fund with an expense ratio of 40 basis points or lower, you are seeing a lot more of the flows. And so some ETF issuers are coming in with low expense ratios, and these, might not be stock picking portfolios. They could be, some type of option income type product, and they have an easier time charging that. I think you are seeing also some actively managed ETFs coming in with slightly higher expense ratios, but they're not seeing that type of flows. And so we really see that the ETF products that are bringing in a lot of the flows have that expense ratio below 40 basis points. And I actually did the same thing with mutual funds. We found that a lot of the flows were going to mutual funds with below 40 basis points, even actively managed products as well.
Which mutual fund company is doing the best, do you think, in terms of managing this, this competitive threat from ETFs?
Well, I think Vanguard's definitely doing a great job. I mean, their funds across the board are lower expenses just due to the nature of their ownership model that allows them to charge much lower fees. So even if you look at their actively managed products, which are many are sub-advised, their fees are much lower than the industry, so they're having a much easier time. But they also have ETFs as well. So I think, whether they see more assets move into the ETF side, they're kind of built for this. And so they're finding success so far. And I think if you look at another company like Fidelity, they've been lowering their expense ratios. At least a lot of their passive products are actually cheaper than Vanguard. But we'll see, I'd like to see more of their products, actively managed products, get a little bit cheaper. And I think, they could be set up for success in the future as well. But Vanguard's really the one that's kind of, doing a great job right now.
All right, David, thanks so much for joining us. That's David Cohne, Bloomberg Intelligence mutual fund analyst. Let's turn now to European equities, where the German market is set up for a constructive year, but is still facing obstacles in the near term. For more, I'm joined by Bloomberg Intelligence European strategist Tim Craighead. All right, Tim, talk to us about the German market. Give us a sense of just kind of how it performed in 2023 and kind of what's the outlook for 2024.
So the German market is really interesting, and it's the DAX index specifically. It was up several percentage points over the course of 2023, which is unremarkable relative to what you're thinking about with the S&P 500. But importantly, it rallied 14% from the end of October to the end of December. So it was a huge rally towards the end of the year. And importantly with that, it was some of its bigger industries. It's heavy on industrials. It's heavy on technology with the likes of SAP and Infineon. And it's heavy on autos. You think about Mercedes and BMW and Porsche. They all had a really big 2-month rally. And it brings us to the new year where we're on the one hand looking at an all-time record index with valuation having run up, but earnings coming under pressure. And it creates this really interesting conflict for Germany, but it's symbolic of what we're seeing across European markets.
So is there a meaningful valuation risk here in the German market?
So valuation, as it stands right now, at about 11.5 times forward earnings, is actually pretty depressed. If you look back pre-pandemic, the index traded somewhere between 12 and 14 times forward earnings. So right now we're below that. During that period, certainly interest rates were well below where we currently are. And so you think there's a little bit of an adjustment factor there. Our work from a fair value analysis suggests that valuation's probably about right. And if inflation continues to wane and interest rates continue to trade off like they have been, then valuation probably isn't too much of a problem. It's really earnings that we're focused on here.
Tim, give us a sense of kind of China. What does that mean for German companies? We know they're a big trading partner with Germany. How does that get factored in?
Yeah, I tell you, this is the real crux of the issue, and it comes back to the earnings question. China looms large, to put it in a couple of words. You've got the German auto companies. I already mentioned the names. They get upwards of 30% of their profits from China. Wow. A couple of them, VW, even more. Yep. You've got the industrial base, which sells an awful lot of industrial goods into the Chinese market. And to the degree that China is stalling, to put it nicely, with the property concerns that continue to plague that economy, COVID. The first half of 2024, we think, is a really tough comparison for the German market. And in particular, if you go back to the auto issue, the Chinese companies like BYD are steaming ahead on electric vehicles and competing really aggressively on pricing. And this is where all the growth is in the Chinese auto market. So it sort of is a double issue for the German auto companies, that, in particular Volkswagen, that have garnered so much of their profit base from China. As we look into 2024, it's a risk factor, especially in the first half of the year, for earnings.
Gotcha. All right, Tim, thanks so much for giving us a few minutes there on the German equity market. Tim Craighead, Bloomberg Intelligence, European strategist. Coming up on the program, the streaming services are no longer at war with each other. Now they're fighting to keep media companies alive. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
Media companies are under stress as consumers keep cord cutting and the box office continues to disappoint. Their one hope is to bring in sustainable profits from streaming services. To discuss how streaming services can keep entertainment afloat, we're joined by Bloomberg Intelligence senior U.S. media analyst Geetha Ranganathan. Geetha, thanks so much for joining us here. It's been a rough, transition, if you will, from the old days when, you just subscribed to a cable system and that paid all the bills for all the big media companies. Now streaming's a little bit different. Where are we in that transition to streaming for some of these big media companies?
Yeah, you're absolutely right, Paul. I mean, it's been a roller coaster for the past few years for the media industry as they've kind of gone through this transition from their linear TV focus to what they call direct-to-consumer. Over the past few years, we've seen a real shift in the narrative, even within the streaming business. So initially, there was this huge focus on streaming subscriber growth, but that has really kind of now changed, and there has been a much greater focus on streaming profitability. So we're seeing companies, obviously, over the past few years, in order to gain subscribers, they had been spending money heavily, and because of that, losses had been piling up. But over the past few months, we've actually kind of seen a potential earnings inflection, and it's still too early to call a turning point. But I think we're generally looking to see better profitability metrics for the streaming business as we kind of head into 2024. All
right, so we know that Netflix makes a profit, so they are a profitable streamer. How about all the other media companies? Are they profitable or not, or do we have a path to profitability? Yes,
so you're absolutely right. So Netflix is the only company right now that is actually profitable as far as streaming is concerned. So they're going to generate roughly about $7 billion in profit in 2023. That'll go up to potentially about $9 billion in 2024. Now, if you look at the rest of the streaming space, all of them are currently making losses, except with the exception of Warner Brothers Discovery, which has its Max product, which is kind of at a break-even point. So just to kind of put all of the other streamers together, they made about $10 billion in losses in 2022. We expect that to actually come down pretty significantly, almost by 30% to about $7 billion in 2023, because everybody right now is in this phase of content costs and non-content cost rationalization. But as they kind of tighten their belts into 2024, we actually see those losses being pared even more drastically to close to about $3 billion. So there is definitely a path to lowering losses for right now. And all of them have said that they look to kind of break even sometime toward, the end of either 2024 or at the beginning of 2025.
All right. So when you look at your earnings models, Geetha, do you ever get to a point where these media companies are generating the kinds of profits that they used to back when we had, 80 to 100 million households paying, $80 a month for their cable bill?
That's a great question, Paul. That has kind of been the lingering question in the media space over the past few years. So when you had that old cable model, we were generating roughly about 30 to 35%, cash flow margins. Can we ever get to that in the streaming world? I mean, that is the burning question. We've seen Netflix already get to about 20 to 22% operating margins. So we know that we can potentially, and Netflix has talked about kind of expanding about 100 to 200 to 300 basis points of operating margin, over the next few years. So we do kind of see them potentially, maybe by 2030, getting to, 30, 32%. Will everybody else be able to replicate that? I am not so sure. I think it's going to take, a lot of time. Obviously, Netflix has a considerable advantage because of being a first mover in the space. They're also, a streaming pure play, which kind of gives them, again, that leg up versus the other companies which are kind of saddled by, their presence in the linear TV world as well. So, I mean, it's going to be hard. I mean, potentially we think that some of these companies can get to about, 15-20% streaming profit margins, but anything over that is probably going to be really, really difficult.
Interesting. Are we going to have some consolidation, some further consolidation, I guess, in the media space, to the extent that maybe scale will help some of these companies get to profitability or higher levels of profitability? I know the current discussion is Warner Brothers, Discovery, and Paramount. So are we going to see more consolidation here?
I mean, there seems to be a lot of, news reports suggesting that, a shakeout. I mean, we've been kind of talking about this, a shakeout, a streaming shakeout where, we're potentially going to see either some of these smaller niche services either go away completely or get folded in with probably some bigger services. I think through most of this year, I think we're going to see a lot of talk about consolidation. Whether it really makes sense or not, I mean, that's a whole different question. I mean, obviously there is, desperate times are kind of calling for desperate measures, I guess. And what most of these media companies are seeing is this really rapid decline in terms of their TV assets and really kind of forcing their hand to do something. I'm not necessarily certain that scale is going to be the solution to all of the problems. I mean, we've already seen some of these companies kind of consolidate. I mean, whether it's, Warner Brothers Discovery, which is a combination of Warner Brothers and, obviously Discovery, but we haven't necessarily seen that translate into, any major increase in their stock price. So, I mean, again, we've got to wait and watch, but I think consolidation will be a major topic through most of 2024.
In terms of the streaming, I saw some recent reporting here that says that churn is really a problem, that people start and stop, and so it's hard for these media companies to retain their subscribers. How big of an issue is that, and what are they trying to do to combat that?
Yeah, churn is definitely a huge issue, and so we've kind of seen a talk about some of these services kind of bundling together. So we've seen some reports about Paramount potentially combining with, Apple TV Plus, and a main concern there is to kind of reduce churn, because the churn for both those services is really, really high. So they're looking to kind of reduce that by kind of, dropping prices, bundling as much as possible, bundling with maybe some of their mobile providers, like a Verizon or an AT&T. So they're trying different strategies. But again, churn is definitely a very, very big issue. Rising streaming prices has been a big focus for most of these companies. They've been raising prices across the board because they're trying to increase their profitability numbers, but that has obviously led to higher churn. So along with increasing prices, one of the things that most of these streaming services have been doing is also introducing lower-priced ad-supported versions. And we're actually going to see a pretty big shakeup in 2024 with the introduction of the Amazon Prime Video ad bundle. I think that is really going to kick things up a notch, if you will, in terms of, the streaming wars. And I think we're going to go from the regular subscription streaming wars to really more the ad-supported streaming wars.
All right, Geetha, before we let you go, how did the 2023 box office shake out, and what's the outlook for 2024?
So 2023 was actually pretty much came in line. We were, expecting a decent rebound. We got to about $9 billion, which is almost 20% above 2022, but it is still lower. It's still about 20% lower versus pre-pandemic levels. But I think what is really disconcerting is that things are not looking that rosy for 2024. I mean, many people had expected 2024 to be the year when we finally get back to, kind of striking distance of those pre-pandemic levels. But I think it's actually going to be much, much lower. We're probably going to see only about $8 billion in domestic box office. And a lot of that is just because of the strike-related delays. So, so many of the tent poles that we had expected in 2024 are being pushed. They've been pushed out to 2025. So it's going to be a pretty tough year, I think, in the box office.
All right, good stuff. Our thanks to Bloomberg Intelligence Senior Media Analyst Geetha Ranganathan. Coming up on the program, 2023 was a slow year for mergers and acquisitions. We might see deal activity pick up this year. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Deal making slowed in 2023 for the second year in a row after peaking in 2021. For insight on why we might see M&A activity speed up again this year, we're joined by Bloomberg Intelligence government analyst Andrew Silverman. So, Andrew, just give us a little quick look back to 2023. What did the M&A market do in terms of activity, and kind of what are we looking for this year?
Yeah, well, generally speaking, M&A was down, as you suggested, in 2023. It was as bad as it had been since 2017. So in terms of comparison, it was a heck of a lot worse than even 2020, the COVID year. But we think that 2024 is going to see an uptick in terms of M&A. Why? Because companies and PE funds have a large amount of cash sitting on the sidelines. Gina Martin Adams has shown that companies have about $1.3 trillion. It's third quarter of 2023 was the fifth consecutive quarter in which companies increased the amount of cash they have on the sidelines, and PE funds as well. Paul Goldberg has said that PE funds have historically high dry powder. So, and they're not using that money to pay, executives more cash, to distribute out dividends, things like that. The money is sitting there waiting to be used for something.
And now we've got, presumably, interest rates will be declining this year. How will that, presumably that will make debt financing cheaper, and that'll be another catalyst. Is that how you're seeing it?
Exactly. That's right. There was an interesting Wall Street Journal article talked about how borrowing costs had increased from 6% in 2021 to 9% in 2023. So it became a heck of a lot more expensive for PE funds and companies to borrow in order to acquire. With inflation coming down, with interest rates probably coming down, with whether or not we're going to have a recession, that issue presumably off the table. Either we have one or we don't, in the first half of 2024. Companies are going to have a lot more certainty. And we think that, with this additional cash and the certainty, that companies and PE funds are going to go out and begin acquiring.
Any sectors that you think look ripe for some, M&A activity?
Yeah, so we think that the consumer sector and the tech sector both look good to us. Gina, again, Martin Adams suggested that the consumer sector is a good bet because it's the one that's been hit hardest by inflation. And she actually thinks that consumer spending won't decline as much as most people think, and yet that pessimism has been built into tech company stocks, so they might actually be undervalued. And in terms of the tech sector, in 2020, 2021, tech was really the driving force behind that enormous increase in M&A. And since then, it's declined to about 8 or 9% of overall M&A in the United States. So if there's going to be a resurgence of M&A, necessarily tech is going to have to be part of that. Plus, Mandeep Singh has said he thinks that there's an overabundance of cybersecurity companies. We actually think that there's a lot of potential also for AI acquisitions because companies are still building up their capacity for AI, and so that might be an area for for acquisitions as well.
In the regulatory environment, sometimes, I mean, it feels like this administration, they're not really keen on, consolidation in a lot of industries. So that could be a headwind, though.
Exactly, right. The FTC, the Justice Department have been pushing back on a lot of these deals. But the interesting thing about it, and this is more Jen Rhee's area than mine, but she said that that these deals are being held up. It's taken longer for them to close, but they are closing, in fact. And so the extent to which the FTC and the Justice Department are having an effect on deals is not as great as it appears to be. Now, there is one area where I think we're going to see a large increase in scrutiny, and that's with regard to CFIUS.
What's CFIUS?
CFIUS is the Committee on Foreign Investment in the United States.
Okay.
And CFIUS has been coming up more and more in company statements. I think just in the past few years, it's gone up in mentions and SEC filings from something like 7,000 in 2019 to 35,000 in 2023. So companies are a lot more concerned about it. And CFIUS actually has the power to shut down deals, right? The FTC, like I said, slows things down. CFIUS actually, in their 2022 report, said that they were responsible for shutting down 20 deals.
Right.
And
Wow.
40 other deals were made to be sort of amended in order to get that approval. And that's because in 2018 there was a big expansion of CFIUS's power, and then President Biden in 2022 issued an executive order expanding CFIUS's power as well. So it's really this up-and-coming force in shutting down at least foreign acquisitions of U.S. companies.
How about take-private deals? I know sometimes they are a big source of M&A activity. What's the outlook there?
We think that that's probably going to be kind of a lagging indicator, just as we think that hedge fund activism is going to be sort of the green shoots indicating that M&A is going to increase in the near future, because we're seeing a lot of hedge fund activism. Elliott, for example, with Western Digital, causing them to announce they're going to split. So privatization is sort of the flip side of that. That when M&A begins to slow down, then you see a lot more privatizations, because it's indicative of companies saying we're not so happy being public. We need more time and to be able to invest in ourselves. And quarterly filings don't work so well for us. And a big rise in M&A and IPOs and things like that are indicative of a much more healthy market. Privatization, sort of the opposite.
So activist investors, what does the data show? Do they actually spur deals to happen, or are they just kind of a nuisance?
Well, they do actually spur deals to happen. We think that what we've seen in the data is that they tend to cause a lot more spin-offs, right? They're trying to get these companies to slim down and focus on what they're good at. And so that tends to force companies to divest. And then that rise in M&A causes sort of a fear of missing out, animal spirits rising amongst other companies. And then that causes much more M&A to increase, generally speaking. But yeah, they are actually having an impact.
All right. Well, we'll see. 2024, hopefully better for the M&A folks out there than 2023. Our thanks to Bloomberg Intelligence government analyst Andrew Silverman. Well, after a few chaotic years, the world of e-commerce may see some normalization, but that doesn't mean the landscape will stop shifting completely. For more on the outlook for global online retailers, I'm pleased to welcome Bloomberg senior retail analyst Poonam Goyal. So, Poonam, I guess if there was any silver lining from a multi-year pandemic, it's that people got pretty good at this whole e-commerce thing. Could you give us a sense of kind of where we are now in the evolution of bricks and mortar to e-commerce?
Sure, Paul. Yes. I think what the pandemic did is really get people more used to and more comfortable shopping online. So if you think about, where we were pre-pandemic in terms of e-commerce sales as a percent of total retail sales, it was in the low double digits. And today we're at 25%. And we expect that to go to 33% in the next 2 to 3 years. So clearly a big progression from where we were.
Yeah, it's just amazing. So, it really feels like, you take a look at the market share. Like the market share I remember from just 4, 5, 6 years ago was e-commerce was maybe 7 or 8% of retail sales. So it looks like the pandemic and the changing buying habits, several years of, I guess, evolution was kind of pulled forward.
It absolutely was. We'd say it was probably around 2 to 3 years of evolution was pulled forward in the pandemic alone. And it's not only just that. It's just think about the technology that was enabled during that time, the whole buy online, pick up in store. Pre the pandemic, the stores would say we're going to roll out 20 stores, 50 stores a year.
And all of a sudden, in 3 months' time, the entire fleet was almost buy online, pick up in store. So just the transformation that happened to go for a BOPIS, which is buy online, pick up in store, or curbside, happened very quickly. And that's still also a part of why online continues to gain traction.
One of the themes for the market overall in 2023 was AI and how that's going to impact various industries and companies. What does it mean for retail and e-commerce?
Yeah, so AI is important, generative AI specifically, and we think the proliferation of generative AI is going to allow retailers to make more informed and better decisions that will drive conversion. Now, that doesn't mean that it's just, at your homepage where now you can basically better personalize to your consumer, but it's also in your back end. It's in your operations. It's in your marketing when you have digital billboards. You name it, they can use generative AI to really improve their return on performance across every category. And you can also bring product to customers faster, because if you think about back in the days when you were designing product, right, at the end of the day in retail, you're selling a product. You would have to go ahead and sketch it out. You would send it over to Asia, which is where most of the manufacturing happens. By the time you got it back, maybe a month or probably likely more than that has passed. Today, everything is digital, and you can have these systems create based on data that they have on what worked, what didn't work, what was featured at the fashion shows, and really design product instantaneously.
Coming up on the program, we'll get more on the outlook for global e-commerce with Bloomberg Intelligence senior retail analyst Poonam Goyal. I'm Paul Sweeney, and this is Bloomberg. Well, after a few chaotic years, the world of e-commerce may see some normalization, but that doesn't mean the landscape will stop shifting completely. For more on the outlook for global online retailers, I'm pleased to welcome Bloomberg senior retail analyst Poonam Goyal. So, Poonam, I guess if there's any silver lining from a multi-year pandemic, it's that people got pretty good at this whole e-commerce thing. Could you give us a sense of kind of where we are now in the evolution of bricks and mortar to e-commerce?
Sure, Paul. Yes. I think what the pandemic did is really get people more used to and more comfortable shopping online. So if you think about, where we were pre-pandemic in terms of e-commerce sales as a percent of total retail sales, it was in the low double digits. And today we're at 25%. And we expect that to go to 33% in the next 2 to 3 years. So clearly a big progression from where we were.
Yeah, it's just amazing. So, it really feels like, you take a look at the market share. Like the market share I remember from just 4, 5, 6 years ago was e-commerce was maybe 7 or 8% of retail sales. So it looks like the pandemic and the changing buying habits, several years of, I guess, evolution was kind of pulled forward.
It absolutely was. We'd say it was probably around 2 to 3 years of evolution was pulled forward in the pandemic alone. And it's not only just that. It's just think about the technology that was enabled during that time, the whole buy online, pick up in store. Pre the pandemic, the stores would say we're going to roll out 20 stores, 50 stores a year. And all of a sudden, in 3 months' time, the entire fleet was almost buy online, pick up in store. So just the transformation that happened to go for a BOPIS, which is buy online, pick up in store, or curbside, happened very quickly. And that's still also a part of why online continues to gain traction.
One of the themes for the market overall in 2023 was AI and how that's going to impact various industries and companies. What does it mean for retail and e-commerce?
Yeah, so AI is important, generative AI specifically, and we think the proliferation of generative AI is going to allow retailers to make more informed and better decisions that will drive conversion. Now, that doesn't mean that it's just, at your homepage where now you can basically better personalize to your consumer, but it's also in your back end. It's in your operations. It's in your marketing when you have digital billboards. You name it, they can use generative AI to really improve their return on performance across every category. And you can also bring product to customers faster, because if you think about back in the days when you were designing product, right, at the end of the day in retail, you're selling a product. You would have to go ahead and sketch it out. You would send it over to Asia, which is where most of the manufacturing happens. By the time you got it back, maybe a month or probably likely more than that has passed. Today, everything is digital, and you can have these systems create based on data that they have on what worked, what didn't work, what was featured at the fashion shows, and really design product instantaneously.
All right, so when you look out the next couple, 3 years, what are the 1 or 2 big trends that you think are going to be big for e-commerce?
I think marketplaces are going to be big. I think all retail, marketplaces are where people are looking to shop because it is their one-stop shop. We often joked about department stores, right, Howard? They were a thing of the past.
Yep.
And I think the marketplace is a thing of the future because it's online, where you can make that one-stop shop. When you think of Amazon, the largest e-commerce retailer in the U.S., when I'm looking for something often, I don't go to Google, I go to Amazon. Like, can I get this on Amazon? So as more marketplaces emerge and the content broadens and deepens and the use of technology is paired with that to make it a more seamless shopping experience, I think that's really what's going to drive conversion, because conversion online is still very, very low. It's in the low to mid-single digits. And trying to increase that is the goal because no one likes sifting through an endless aisle.
Yep. I mean, that sounds like the old success rates for junk mail and that kind of stuff, inserts. So in reality, though, who competes with Amazon?
Everyone, right?
Yeah, but who competes as a market? Like, you talk about marketplace, and I'm like, I only know really one marketplace, don't I?
You really only know one big one, but there are others. It depends on the category that you're looking at, right? So if you're looking at pets, Chewy is a marketplace.
Okay.
If you're looking at home, Wayfair is a marketplace. If you're looking at unique giftable items and maybe just some, trinkets here or there, Etsy is a marketplace. If you're looking at apparel, Revolve is a marketplace. So I think it just really depends.
Okay,
Amazon does everything, right? It's the everything store. But it does have competitors in many verticals that it competes in where there are marketplaces within them. And then you've heard of it, Paul. I'm sure Temu, Shein, they're coming up in the U.S. and they're definitely gaining traction fast. And they are a competitor to Amazon.
All right. So how do you invest in this theme here? Like, I mean, do I just go buy Amazon and feel like I've got it? Or how do investors really try to get exposure?
So you can decide if you buy Amazon, but I can tell you that Amazon has plenty of opportunity to grow. We often talk about how big Amazon has become. It has over $500 billion in GMV. It has a growing cloud business. It has a very young advertising business. As the latter two of the businesses scale and are more profitable, that coupled with an online business, the GMV, also doubling to over $1 trillion. There's a lot more here happening for Amazon. So we think, and if you layer that all together with profits, right, which has come to focus, they're going to be profitable, more and more profitable as each year passes because of these more profitable advertising and cloud businesses. So the path or the view for Amazon is still that there's plenty of growth out there.
And Walmart seems to have made, every time I see a Walmart press release, I mean, what kind of jumps out at me, not just the absolute numbers of revenue and profit, is just the growth rates of their e-commerce platform. So how are they doing relative to, I guess, Amazon and others?
They're great. And what's great about this is that e-commerce isn't that if one wins, the other loses, because we're still at only 25% of total retail sales. So there's plenty of opportunity for many to gain share here. But when you look at the size of Walmart's e-commerce business to Amazon's, they're nowhere near each other. So there's still a wide gap. And I think given that they could still post healthy growth rates because they're still young, they're still a relatively young e-commerce business.
How about just outside of the U.S., is there an e-commerce opportunity that maybe somebody's a little behind the U.S. and maybe it's better to go to Europe or go to Asia?
I think e-commerce is pretty prevalent, and it's probably more prevalent in outside of the U.S. because some of those markets are emerging markets, like when you look at Asia, where the consumer grew up on e-commerce more than they did on stores.
Yeah, interesting. So e-commerce is here to stay. I've gotten actually pretty good at it, so how about that? All right, our thanks to Bloomberg Intelligence Senior Retail Analyst Poonam Goyal. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.